Thank you for joining today's webinar on GASB's new OPEB statements and communications resource materials. My name is Hank Kim, and I'm the Executive Director and Counsel for the National Conference on Public Employee Retirement Systems. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. In today's webinar, we will review the Governmental Accounting Standards Board's latest Other Post-Employment Benefits, OPEB, standards, and the discussion of available GASB resources. Our panelists today are Dean Mead, Senior Research Manager, and Emily Paul, Project Manager with GASB. We encourage audience participation. Please submit questions by using the GoToMeetings portal. However, to ensure that we can cover all our topics, we will hold your questions till the last part of the program. Dean, Emily, I'll turn over the webinar to you now.
Thank you very much, Hank, and thank you to the members of NCPERS. We're very happy to be with you. I'm going to take the first handful of slides, talk a little bit about some of the background to the OPEB standards that we issued, and then turn the microphone over to Emily, who is truly the person on this call who knows what she's talking about, and she'll walk you through the particulars of the OPEB standards in the context of the communication materials that were developed for the use of OPEB plans and pension plans and employers for communicating as plain Englishly as possible about the requirements of the OPEB standards and the implications of implementing them. And then hopefully, as Hank said, we'll have plenty of time left over at the end to answer your questions. So a little bit about the background behind the OPEB standards. Back in 2006, which seems like a very long time ago now, the board initiated pre-agenda research that was designed to go back and look at the pension standards first and foremost that had been in place for about 10 years at that point in terms of when they had been implemented, and had come out even a little bit earlier than that in the 1990s. And we spent about 2 years doing a very extensive re-examination of how those standards were functioning in practice and the usefulness of the information that resulted from applying those standards to people like bond raters and mutual fund analysts and citizen groups and legislators and legislative staff and so on. That included doing a dozen or so roundtables in different places around the country with different types of stakeholders, some people from plans, some people from employers, some users of financial statements, some auditors, actuaries, benefit consultants, and so on, to identify what issues they saw in practice with respect to those pension standards. We also looked at several hundred financial reports from employers and plans, did interviews and conducted surveys, and took all those findings to the board about 2 years later in 2008, at which time the board decided to initiate a project on post-employment benefits, the first part of which resulted 4 years later in statements 67 and 68 on pensions. And then when those were done, while the board was actually working on providing implementation guidance to plans and to employers to implement those standards, they were already beginning to work on the OPEB standards with at least one of the goals of those projects that resulted in 74 and 75 being to once again reestablish a single approach to reporting for retirement benefits, regardless of what type of retirement benefits they are. So these statements, statements 74 and 75, are effective for 74 for fiscal years that ended June 30th of last year and afterward, so December 31st of 2017 as well, if you're a calendar year plan. And then for employers, Statement 75, we're in the fiscal year, nearing the end of the fiscal year for which they are required to first implement, June 30th, 2018 and later. although we have encouraged early implementation and know that there have been some governments that have already implemented both 74 and 75. You may remember when Statements 67 and 68 came out that the chairman of the GASB, Dave Vout, organized a lot of relevant organizations, including NCPERS, to discuss how they might assemble some plain language communications that plans and employers could use to help explain to citizens, to clients, to participating members of the plan, what these standards were all about and what the implications of them would be. This was particularly important because these standards were making a break from their close connection with funding to be more of a purely accounting-based set of standards. And so there were a lot of questions in particular about whether there was going to be any impact on how governments approached the funding of pensions. And so these communication materials were developed that answered a lot of those prevalent questions. And a similar process was engaged in, I think, beginning late last year and continuing into this year to produce a set of similar materials that are available on the GASB website. If you go to the GASB homepage, you will see some rotating pictures there, and one of them has to do with all the other post-employment benefits, and that more sign in the corner. If you click on that, it'll take you to this page. And then if you click on educational resources at the bottom, that will open up a series of links right underneath that. And the very first one at the top is the OPEB communication resources. That's a link to the materials that Emily is going to talk to you about now.
Great. Thanks, Dean. And that's where you can find them. So these materials really focus on major changes from the prior accounting standards and the new information that will be provided. They're in a question and answer format, and they cover 7 broad topics that really highlight what we anticipate will be common questions about the effects of the new accounting standards. So today I'm going to give an overview of each of the 7 sections, including going through at a high level the accounting requirements that are relevant to each section. So we'll start with the first section, and this really is about the relationship between the accounting standards and the OPEB liability. So as a refresher, OPEB is comprised of retiree healthcare benefits and other post-employment benefits that are not provided through a pension plan. So for example, death benefits, life insurance, disability, or long-term care, any of those types of post-employment benefits that are provided outside of a pension plan, plus all retiree healthcare. So to answer the question that's on the slide, no, the accounting standards did not create the OPEB liability. The liability is a result of a formal or informal agreement by a government to provide OPEB to its employees. The new accounting standards improved the approach to measuring that liability that's reported in the financial statement, but the liability itself arises due to governments providing OPEB to their employees as part of their compensation. So each section, as I mentioned, is structured using questions and answers. So this slide presents the key questions and answers that are covered by this topic. These questions and answers in this section really get at some of the more foundational aspects of the standards, particularly regarding why a liability is reported. And so a lot of those questions can be answered going back to the fundamental approach that was taken for OPEB. So that approach is essentially the same as that was taken for pensions. So the accounting model as a whole for post-employment benefits is viewed within the context of an ongoing career-long employment relationship, and that affects aspects of the measurement of the liability and expense, which I'll get into in some of the later sections. The model has really shifted, as Dean alluded to, from a funding-based approach to an accounting-based approach. And some of the benefits of that shift is that now a liability will be reported for the amount of OPEB that has been earned but not financed as of a specific point in time. Also, the full, if you will, OPEB expense that was incurred during the reporting period and that's based on the changes in the liability will now be recognized. The accounting-based approach also has the benefit of enhancing comparability. Unlike a funding-based approach, which could vary substantially between governments, now under the accounting-based approach, each government will be measuring their liability in the same manner. So the second section of the materials really focuses on what's going to show up in the financial statements as far as the size of the liability, what amount is shown, and how that's changed from the prior standards. So because of changes under the new accounting standards and the methods that governments use to measure the OPEB liability, the amount that you're going to see on the face of the financial statements may be significantly larger than the liability that was previously reported. And the amount that was previously reported is called the net OPEB obligation. We'll get into the specific terminology here in a couple of slides. Additionally, the OPEB liability that is presented in the notes, which supports the amount that's shown on the face, might be different than the amount that was previously reported in the notes to financial statements. Again, these accounting standards are going to improve the comparability across governments because everyone's using the same methods to measure the liability and the expense. However, the accounting standards do not change the amount that governments are required to contribute to their OPEB plans or the amounts that they would need to finance their benefits on a pay-as-you-go basis. So the key questions and answers that are covered by this section really focus again on the measurement of the liability and the changes in the measurement from the prior standards. And so I'm going to dive a little bit deeper into what's going to be required by the new accounting standards as far as measurement. So here we have what you saw previously under Statement 45, which is the prior accounting standards for the OPEB reporting, and what you're going to see under Statement 75. So on the face of the financial statements, you previously saw the net OPEB obligation, and now you're going to see the net or total OPEB liability. In the notes, you previously saw information about the unfunded actuarially accrued liability, and now you're going to see information about the amount that's presented on the face of the financial statements, so either the net or the total OPEB liability. So let's talk a little bit about what the net OPEB liability is. That's calculated as the total OPEB liability less OPEB plan net position. And you're going to see a net OPEB liability reported on the face of the financial statements if the benefits are administered through a trust that meets the specified criteria. The specified criteria for the trust is the same under Statements 74 and 75 as they are under the pension standards. So contributions are irrevocable, they're dedicated to providing benefits in accordance with the benefit terms, and they're not subject to creditors. So again, if there's a trust established that meets that criteria, then the net OPEB liability is reported. If the OPEB plan is not administered through a trust that meets the specified criteria, then the total OPEB liability will be recognized. There's no reduction of that liability by the plan net position. So let's talk a little bit about how the total OPEB liability is measured. It can be described in three broad steps. You first project the benefit payments, and then you discount those projected benefit payments to their actuarial present value, and then you allocate that actuarial present value to past periods of service. So in general, these three broad steps are the same as were the same for measuring the UAAL under the prior standards. However, it's the certain pieces within these steps that have changed and really what's going to cause differences. So I'll get into the big changes here on the next slide. So the key changes in measurement really occurred in the areas of discounting, attribution, and valuing plan assets. So starting with the discount rate, previously the discount rate was based on the long-term expected rate of return on investments that were expected to be used to make benefit payments. And those investments were either plan investments for a funded plan, or the employer's investments for a pay-as-you-go plan, or a weighted average of the two for a partially funded plan. Now, under Statement 75, the discount rate is going to be the long-term expected rate of return if plan assets are projected to be sufficient to cover projected benefit payments. Otherwise, there's an incorporation of the municipal bond rate, resulting in what's sometimes referred to as a blended discount rate. So for projected benefit payments that are not expected to be covered by projected plan net position, those benefit payments are discounted using the municipal bond rate. And in addition, if the OPEB is not administered through a trust that meets the criteria, the municipal bond rate is also used as the discount rate. So on this point, here's a little bit of a difference from moving from the old pension standards to the new pension standards versus moving from the old OPEB standards to the new OPEB standards. In that OPEB, a lot of OPEB has historically not been fully funded. So they may already be using a blended rate, if you will. And so there may be less change from what they were using before to what they're using now than what we maybe see on the pension side. The second area of key changes is in the attribution, which I mentioned. So previously under Statement 45, there was a choice of 6 methods, and they could be applied as a level dollar amount or as a level percentage of pay. Moving to Statement 75, there's one method that's required to be used, and that's the entry age actuarial cost method applied as a level percentage of pay. And then finally, there's some differences in how plan assets are measured. So if the plan is administered through the trust and the total OPEB liability is reduced by plan net position, now that plan net position is required to be measured at fair value, whereas previously under Statement 45, plan assets could be valued at their actuarial value of assets, which incorporated a smoothing technique. So we'll move into the third section of the materials, and this section focuses on governments that participate in cost-sharing plans. So a cost-sharing plan is first administered through a trust that meets the specified criteria. So I'd like to reiterate that point, that there must be a trust for a plan to be considered cost-sharing. And then second, it's an arrangement in which those plan assets and then liabilities to the employees are shared among the participating employers. So under Statement 75, governments and cost-sharing plans will recognize their proportionate share of the collective net OPEB liability for the first time. Previously, governments that participated in cost-sharing plans generally just recognized their statutorily required contribution to the plan, and unless they hadn't made that contribution, there was generally no liability reported associated with OPEB. So the key questions and answers that are in this section really focus on what will now be reported by cost-sharing employers and why. Again, this is new for cost-sharing employers to recognize their proportionate share of the liability. So I'm going to dive a little bit deeper into the requirements for cost-sharing employers. So the approach that's taken in Statement 75 is essentially the same as that's taken in Statement 68 for cost-sharing employers and pension plans. The collective net OPEB liability would be determined at the plan level and then allocated to participating employers. The allocation is done based on each employer's proportion, which is based on a comparison of an individual employer's contribution effort to the contribution effort of all employers within the plan. Each employer would then multiply the collective net OPEB liability by their proportion to determine the proportionate share. And that's what you're going to see on the financial statement. So the employer proportion times the collective amount equals their proportionate share, and that's what each government will be recognizing. So I think some of the questions that we get a lot about cost-sharing employers is why should they recognize their OPEB liability? And really here, it's, regardless of plan type, the employers have made a promise to their employees to provide OPEB in exchange for that employee's service. So it's part of their compensation. And regardless of whether it's through a cost-sharing plan or through a single employer or agent plan, there is a liability that exists. So the fourth section of the materials focus on OPEB expense and how that calculation of OPEB expense is changing. So the new accounting standards are no longer based on a financing approach, as we've discussed earlier. And so previously, expense was based on the annual required contribution, known as the ARC, and changes could be recognized in expense over a period of up to 30 years. Under Statement 75, many events that affect the OPEB liability will be recognized in OPEB expense immediately. And some events will be recognized in future periods, but over significantly fewer years than were recognized in the past. Additionally, now the expense is based on changes in the liability. So there's several key questions and answers in this section, talking all the way from how it was measured previously to how we're going to measure it now, what types of changes are recognized immediately, and what's going to be recognized in the future. And we'll get into a little bit about the deferred outflows and inflows on the upcoming slides. So certain changes are reported in OPEB expense immediately, and those include service cost, interest on the beginning balance of the total OPEB liability, as well as any changes in the benefit terms. So you're going to see those in the period in which they occur. Other items will be reported as a deferred outflow or inflow and then introduced into OPEB expense over a certain amount of time, depending on the type of change. So there's two types of changes that are recognized into OPEB expense over the average expected remaining service life of all members of the plan, so both active and inactive. And those two changes are changes of assumptions and experience gains and losses. So when we're talking about changes of assumptions, we mean, for example, changes about mortality or a change in the discount rate. That's going to show up. Again, that change will be recognized as a deferred outflow or inflow depending on the direction, and then recognized in OPEB expense over the average expected remaining service life. As far as experience gains and losses, what we mean here, an example of that would be if your actual claims costs were different than your projected claims costs. Again, that difference is initially reported as a deferred inflow or outflow and then recognized into OPEB expense over the average expected remaining service life. There's another type of change that's recognized as a deferred outflow or inflow and then introduced into OPEB expense, except for this is over a set period. It's a 5-year closed period, and this is for investment gains and losses. So this change, again, would only apply if you have a trust that meets the criteria and you have plan assets. But then the investment gains and losses would be shown in OPEB expense over a 5-year period. So this slide makes what I think is a very important point, and this is with regard to employer contributions. So employer contributions are not intended to be the OPEB expense amount. I think previously under prior standards, there was thought to be a relationship between the amount that was contributed and the expense amount. Here, we've really moved to a full expense reporting that focuses on the changes in the liability. So under the new accounting model, employer contributions are a direct reduction of the liability, and they actually do not flow through expense. And so even if the government contributes based on an actuarially determined amount, that's usually calculated differently from the OPEB expense. And now we'll move into the fifth section of the materials. This section is about notes and RSI. So under the new standards, there will be expanded note disclosures in RSI that will allow for comprehensive reporting about OPEB liabilities and expense. The expanded RSI schedules will ultimately be 10 years of information, and this will allow for trend analysis. And so the key questions and answers that are answered as part of this, that are covered as part of this section, really focus on how the usefulness will be enhanced. And Dean's going to walk through some of the things that you can expect to see and talk a little bit about what's in notes and RSI under the new standards.
Not necessarily because I'm better equipped to do it, but we do need to give Emily a chance to catch her breath and rehydrate. The first thing that you see here on this slide is an example of a new disclosure that's required for governments that are in single and agent multiple employer OPEB plans, a breakdown of the types of members of the plan at a minimum in these three categories: the active employees, the inactive employees or beneficiaries that are currently receiving benefits, and then the inactive employees who are entitled to receive benefits but are not yet receiving them. You may see, as you have with the pension disclosures, some employers providing greater detail under some of those categories, but at a minimum, those are the three that need to be presented. The disclosure at the bottom of the slide is a disclosure that all employers are required to make regardless of what type of plan they're in, which is, this is an example of part of what you would see for the disclosure of the methods and assumptions that go into the measurement of the OPEB liability. So you're going to see some of the key factors that are included in the projections of the benefit payments, such as most notably probably the healthcare cost trend rate, but also other things like the investment rate of return that is assumed if the plan is administered through a trust that meets the criteria and has assets, salary increases if they're relevant to the calculation of the benefits. They often are not, but in some cases, if they are, it's a key measure, a key assumption that needs to be included. Inflation is almost always one of those key measures that you're going to see there. And then the very bottom here is showing an example of an additional requirement beyond what was required for the disclosure of methods and assumptions under the old standards, which is to show more detail about how the long-term expected rate of return is developed, how that assumption is developed. It used to be that you could just disclose that amount, but there's an expectation now of providing some explanation as to how that long-term rate was arrived at, and that includes a breakdown of the asset portfolio of the plan by major asset class, showing what their expected allocations are, and showing the real expected long-term rate of return for each of those classes of asset. As with the pension disclosures, there is a required disclosure that shows the impact of the assumption about the discount rate on the measurement of the liability. So if, for instance, in this example, the discount rate that's used is 7%, then you're going to see what the net OPEB liability or the total OPEB liability, as the case may be, would be if that discount rate were 1 percentage point higher and 1 percentage point lower. So in this example, 6% or 8%. In addition, for OPEB, there's a similar disclosure regarding the assumptions for the healthcare cost trend rate. So you will have what the assumption is in the middle, and that shows the net OPEB liability or total OPEB liability that's actually reported in the financial statements, and then what that liability would be if the healthcare cost trend rate was 1 percentage point higher and 1 percentage point lower. So this is giving the users of the financial statements some really valuable information about how sensitive that measure is to variations in the assumptions that that the employer or the plan is making as they measure the liability. And there's probably no two more important assumptions than the discount rate and the healthcare cost trend rate in that calculation. This disclosure should look just like what you've seen for pensions. It will be made only by governments that are in single and agent OPEB plans, and it is essentially a walkthrough from the beginning of the period to the end of the period of the causes of change in the net OPEB liability. Things like service cost, interest on the beginning balance of the total OPEB liability, contributions, benefit payments, all these things affect the total OPEB liability and or the fiduciary net position of the plan. And this is something that when we were doing the research back in 2006 to 2008, that we heard from all kinds of stakeholders, not just users, but from people in plans, from employers, from auditors, about how important it was to understand not just how much the change was overall, but to understand what was driving that change from year to year. What you may be more likely to see for OPEB disclosures, because so many plans don't have assets set aside in a trust that meets the criteria, is just this one single column in the disclosure that shows the change in the total OPEB liability. Because there is no plan net position and therefore no net OPEB liability, you'll see just this single column that will present the items that cause changes in the total OPEB liability. And then in the required supplementary information schedules, ultimately, as Emily said, you'll get a 10-year schedule. And this is effectively that right-hand column from the note disclosures we were just looking at. So in the first example, where there was both changes in the total OPEB liability and changes in plan fiduciary net position that were affecting the net OPEB liability, you'd see that cumulative impact on the net OPEB liability over the last 10 years. So you're getting not just what happened in the last year, but a really nice historical perspective on greater forces that are at work driving either increases or decreases in the size of the liability. If the government doesn't have a trust that meets the criteria and therefore its note disclosure is just the changes in the total OPEB liability, then the sort of bottom half of that schedule wouldn't be there. You'd just see the 10-year trend in the changes in the total OPEB liability. But you'll still see the information at the bottom, either here or in a separate schedule. If the pension standard implementation is any indication, they'll probably be in the same schedule, and that'll be showing that since there is no plan net position, I'm not even sure if they will show the ratio of plan net position to total OPEB liability. Emily is shaking her head vigorously. So they won't show that, but they will show the payroll measure, and they will show the total OPEB liability divided by the payroll measure, which is a really key ratio that that financial statement users employ in order to do comparisons of employers and plans of different sizes, and also to get a sense of the magnitude of the liability and how significant it is given the size of the government. If a government's in a cost-sharing OPEB plan, the schedule it presents here will look different because it didn't present the note disclosure of these changes, and so it doesn't present the RSI. But what it does show is ultimately a 10-year trend in their proportion, so their percentage of the total OPEB liability, or net OPEB liability, as the case may be, their proportionate share, so the dollar amount that they're recognizing in their financial statements. They'll show the payroll measure, and then their proportionate share of the liability divided by payroll, and for the plan as a whole, the fiduciary net position of the plan divided by the total OPEB liability. So that's not precisely, if you could even figure out what an individual employer's funding level was, it may not be precisely the same, but it is at least giving the reader a sense for the plan as a whole, how significant its assets are relative to the size of its liability. The other RSI schedule that is almost always presented for pensions, but may not be as frequently presented for OPEB for reasons I'll explain in a moment, is the schedule that's showing employer contributions. If an employer has an actuarially determined contribution amount for OPEB, then it will present this schedule that shows what its actuarially determined contribution amounts were for each of the last 10 years, what its actual contributions were in relation to that actuarially determined amount, the difference between the two, if any, and if there isn't any difference, there still should be a line there that shows that there was no difference. Then the same payroll measure and a ratio of the actual contributions to the payroll measure. Again, another valuable common sizing kind of ratio that allows users to make comparisons and to understand the magnitude of the contribution burden that the employer has. If a government doesn't have an actuarially determined contribution amount, and that's probably the vast majority of employers with OPEB, if they instead have a contractually based contribution amount or a statutorily based contribution amount, then this schedule is going to present that rather than an actuarially determined contribution amount. It'll compare what's required with what's actually been contributed for the period, and then still show the covered employee payroll number, in most cases probably covered employee payroll, and then the ratio of contributions to covered employee payroll. But as I said before, you're probably less likely to see this for OPEB employers than you were for pensions, because in a lot of cases, what constitutes a contribution is either retiree health insurance premiums that are being paid or benefit payments that are being made directly by the government if it's self-insuring. And in those cases, they don't have what constitutes a contribution requirement, so there's nothing to compare their contributions to. And in those cases, I don't expect that we will see these RSI schedules for those employers. Now I think Emily has recaptured her breath, and I'm going to turn it back over to her to cover the rest of the slides.
Great. So the sixth section of the materials is about the ARC. Now, this might, as Dean was alluding to just in this last section, have played a more significant role on the pension side, where plans are generally more well-funded than they are on the OPEB side. So when we were developing these materials in terms of pensions, there were a lot of questions about the ARC. And even when we were developing the standards themselves, there was still some desire to have this measure presented. But as we mentioned earlier, the OPEB accounting, similar to the pension accounting, is no longer based on the ARC. It was determined that the ARC does not always appropriately reflect expense for the reporting period. And it also gave some users the impression that measures were comparable across governments when, as we've talked about, there were several different methods and assumptions that they could choose from. And so they really weren't as comparable as maybe sometimes people thought that they were. However, some governments will continue to present information about contribution measures, and that's what Dean just talked about on the prior slide with that actuarially determined contribution schedule, and that'll sort of give an idea of whether they're meeting those contribution targets. Again, this would be presented if the benefits are administered through a trust that meets the criteria and those contribution requirements are either actuarially or contractually or statutorily determined. So this section focuses on what happened to the ARC, which I think that we've talked about a little bit, and then why not continue to require governments to provide information on the ARC. As I mentioned, there was a lot of desire to have some type of measure here. And the GASB, the board considered but decided not to establish standards that would require governments to report information about the ARC. Really, it comes down to two reasons that they felt that this information was not necessary. Continuing to report the ARC would have, in some cases, resulted in governments reporting 3 sets of information that's related to OPEB in the financial report. They would have the accounting-based information, the ADC or statutorily or contractually required based information that is required for some governments, and then the ARC-based information. And that just seemed to be a lot and perhaps confusing to what the differences were between all those measures. The other reason is that the information about the government's ADC, if they're calculating that and presenting that, is actually more relevant to the accounting liability than information about the ARC would have been. The ARC was calculated based on an established set of parameters that was set by the prior accounting standards, and that may not be directly relevant to the government's funding policy. So the ARC may or may not reflect that policy, whereas the ADC does reflect their funding policy if they're calculating one. And then moving into the last section that's covered by the materials, this is really a broader look at how the OPEB liability affects net position. So net position is the residual of all other elements presented in a government statement of financial position for government-wide activities, proprietary funds, and fiduciary funds. And so really what we're seeing here is that changes in the way that the OPEB liability is now going to be measured and reported might have a significant effect on the net position, particularly in those cost-sharing cases where employers previously weren't recognizing anything likely, or even in the single or agent employer case, the liability that's reported on the face of the financial statements could be significantly larger than what was previously reported, depending on a government's particular circumstances. And so this section has a couple of key questions, and really just focuses on that there might be a big change in the year of implementation when this number gets booked on the financial statement. So that covers all of the sections that are in these materials. A little bit more about the materials. So each section that we cover today is intended to be a standalone section that you could go to and take out and answer questions about. It has key points that are listed, and then again, those question and answer format covering some of the things that we discussed today. Again, these materials are non-authoritative, so if you're looking for our authoritative guidance, you certainly want to refer back to the statements themselves, Statement 74 for the OPEB plan reporting, and Statement 75 for the employer reporting. And overall, what we're really seeing on the OPEB side, we're seeing a lot of similar things to what we saw during pensions. I think as far as major differences, I think that a lot of it stems from differences in plan structure, as we've kind of alluded to throughout the presentation. I think there's fewer cost-sharing plans that we're going to see, so more implementation on the single employer side, certainly more plans that aren't administered through trusts. And so the differences really are appearing out of those plan structure concerns. And so with that, I think we have quite a bit of time for questions and answers if I'll turn it back over to you, Hank.
Great, thank you. We do have a number of questions. So first is, how do we determine proportionate share if we do not contribute to the plan, i.e. pay-as-you-go arrangements?
Sure. So I think here we're talking about a cost sharing, what's presumed to be a cost sharing plan. Again, just to reiterate that there has to be a trust for something to be a cost sharing plan. So if you're in an arrangement that is cost sharing in nature, but there's no trust that meets the criteria, each employer actually is applying the single employer requirements. And so each employer is having a valuation for their own employee group and applying the requirements that are essentially the same as the single employer requirements. Now, if you are in a true cost sharing plan and your plan's administered through a trust that meets the criteria, and there's an employer that doesn't contribute, then their contribution effort is zero. And in effect, they have zero proportion. Again, the encouraged method is a long-term contribution effort, so looking at what would be expected to be contributed by that employer over the long term relative to all contributions that are being made to the plan.
And I think you correct me if I'm wrong, Emily, but some governments may think they're in a cost-sharing plan because they're part of maybe a health insurance cooperative or some type of arrangement where a lot of governments have come together to purchase insurance as a group, for economies of scale or because it gets them lower premium payments. But that doesn't necessarily constitute, from an accounting perspective, a cost-sharing plan, because there tends not to be any accumulation of resources and a sharing of costs. That whatever premiums they negotiate for this consortium as a whole are then paid by each of the individual employers, based upon how many employees or retirees they have who are a part of the plan. And that's not the same thing as a cost-sharing arrangement in which there's a trust that meets the criteria and where they're accumulating resources and then paying all of the benefit costs out of that same pool of resources.
Mm-hmm. And we have to remember, too, that when we think about a traditional cost-sharing plan, and this is very well illustrated on the pension side, we are viewing it in that long-term context where the employers are in this plan for the long haul. And I think in a lot of these arrangements that Dean's talking about, there's the ability to move from group to group each year almost. So.
Great. Another question is, for the RSI info shown on slides 33 and 34, will we need to show only the current year in our first year of disclosure, or will we need to compile and show 10 years in history? I think for pensions, we are only showing the year since the schedule was started.
That's a very good question. As far as the schedule that shows the changes in either the total OPEB liability or the net OPEB liability, as the case may be, you don't have the information really to go back probably more than the year prior to implementation. In some cases, I've seen governments with pensions who, in their year of implementation, they had 2 years worth of information, and so they started out with 2. The minimum requirement is to start out with that first year of information for the measurement period and to build it up prospectively. With respect to the contribution schedules, there's something of a difference of opinion about whether those should be presented for a full 10 years or not. Because that information has been presented in prior years, a lot of that information may be available, in which case, my view is that a government should present all of the information that it has available for those years. Where it may be problematic for some governments may be the issue of covered employee payroll as the payroll measure, and if that's something that they indeed do not have for prior years, that they weren't collecting for the members of the OPEB plan, then it may be that they can't present that. But even in those circumstances, I don't think that the option is supposed to be not to present any information for the prior years, but to present the information that you have for the prior years, which I think is at least your contribution requirement and what your actual contributions were. And then if you don't have covered employee payroll for the previous years, you would only show that for the years you have it and show the ratio for those years.
And I do think that the covered employee payroll issue is less on the OPEB side. It was certainly something that came up on the pension side, and I'm sure that many of you are aware of the Statement 82 that amended the measure that's required to be presented, but I do think that that's less of an issue on the OPEB side.
And why don't we close out the Q&A with this last one, which is, in addition to the communications materials, what other resources or educational materials does GASB have?
Sure. So I'll take this time to highlight from a preparer standpoint. We just issued an implementation guide in December for Statement 75. So that's providing authoritative Level B guidance on implementing the accounting standards. Now, of course, the materials that we presented today, as Dean said, are a little bit more plain language and intended really to be used to communicate with your stakeholders about the effects of the new standards. We also have some videos and podcasts that are on our website that you can find in that section of our website, as well as some articles that are more informational in terms of what the standards are and when they were issued. So we have those materials as well. And
there's previously an implementation guide issued for Statement 74 as well, which you may already be aware of, given that implementation has already been underway for that for a while. But that is there as well, and those. Emily was a part of the team that put those together. I only admired from a distance. There's a ton of information in there, and it's arranged in a way that it's very much like the standards, in a way that's really easy to find the part that's applicable to you. And you don't really have to hop around a lot to find, what you need to know about topic A and then topic B. If you're in a single employer plan, you get most of what you need in one part of the implementation guide, and that's I think really should be very helpful to preparers and other people at the plans, as well as auditors and actuaries and others who are involved in the process of putting this information together.
And those implementation guides also include some illustrative materials as well.
Yeah. And they're available for free. Just that, you can purchase a printed copy if you really like to have that tangible document in your hand. But all of GASB's pronouncements, all of its implementation materials are available free on the website, either as freestanding documents or searchable in the Governmental Accounting Research System, or GARS, which is also available to be used free online.
Great. Dean, Emily, thank you so much for this wonderful presentation and walking us through both the statement as well as the resources that are available. At the conclusion of this webinar, there will be a 3 short question survey that we ask you to answer. And the next NCPERS webinar will be in April, where we talk about a secure choice and other state facilitated retirement savings programs that are online or coming online. Thank you so much for participating, and we look forward to hosting you again in April.